It's funny when you think about it, we're always hearing about these incredibly liquid markets, trillions of dollars sloshing around every day. It's almost like you'd think moving a big chunk of money would be like, flipping a switch. But I bet everyone listening has run into this at some point, where you go to make what seems like a pretty basic trade, and all of a sudden it's like, wait a minute, what's going on here? It takes way longer. Or the price starts moving against you.
You hit the nail on the head. It's this very idea that huge markets should be able to absorb big trades in a snap. No problem.
Hmm.
And yet that's not quite how it works in practice. And that's where market microstructure comes in. This is really about understanding the nitty-gritty of how prices actually form. And there's this guy, Jean-Philippe Bouchaud, professor at École Polytechnique, and also, get this, president of a hedge fund called CFM.
So he's got that real-world experience, too.
Yeah, exactly. He's not just an academic. He's actually out there trading.
Mm.
And that gives him a pretty unique perspective, on all this.
Totally. And for this deep dive, we're really zeroing in on some of the key things that Bouchaud's observed, especially from his time at CFM. We're going to look at why, even in these massive markets, you can't just place a huge order all at once and expect it to go through smoothly.
Right.
And maybe even weirder is how each little trade, even tiny ones, can actually nudge the price. This is what I find so fascinating. If you can get a grasp on these hidden gears, it totally changes how you view market movements and the real costs that come with trading.
Absolutely. So let's zoom in on Bouchaud's experience at CFM. He noticed something pretty counterintuitive. Even when they wanted to trade a decent amount for their fund, mind you, significant for them, but still pretty small compared to the whole market, say like 1% of the average daily volume of a stock like, IBM or Apple, even then they couldn't just execute the whole order in one shot.
1% for stock like that doesn't seem like a lot to move the needle.
Yeah, it's surprising. And Bouchaud, he put it in a very colorful way. He said they often had to reprendre à 50 fois, which basically means try 50 times to find enough willing buyers or sellers right then and there to fill that, seemingly small 1% order. And that really illustrates a key point, that even though the total daily volume traded might be huge, the actual amount of liquidity you can access at any given instant can be surprisingly thin.
So it's like, imagine a giant lake, but only a tiny bit of the surface is actually available for boats to dock at any one time.
That's a great analogy. Bouchaud himself uses another vivid image. He says the market is like a jeu de cache-cache, basically a game of hide-and-seek between buyers and sellers.
Yeah.
The liquidity isn't just sitting there. It kind of pops in and out as different players decide they want to trade throughout the day.
Okay, now I'm starting to see the bigger picture. So you can't just dump a huge order or buy a ton all at once. You have to break it up into smaller chunks over time. And this leads us right into another big insight from Bouchaud, the impact of those individual trades on the price.
Right. And this brings up a critical question for anyone who trades. What happens to the price as you're chipping away at that big order with all these little trades? Bouchaud, looking at tons of data from CFM, noticed something fundamental. Every single trade, even tiny ones, exerts some pressure on the price. Basically, buying pushes prices up and selling tends to push them down.
Which makes sense. It's just supply and demand at work. But what's the not so obvious part when we're talking about a big order that needs to be broken into lots of smaller ones?
Well, here's where it gets interesting. Let's say you want to buy a bunch of something, and you have to do it in steps. Each purchase you make slightly increases the demand, so it pushes the price a bit higher. Now, over time, as you fill the entire order, you've probably ended up paying a higher average price than when you started. And it works the other way, too. If you're selling, each sale adds to the supply, which nudges the price down a little, so your average selling price ends up lower.
Ah, I see. So by trying to execute this large trade in a market that seems liquid, you actually end up adding to the cost of the trade itself. There's a real price impact that comes with this, something a sophisticated outfit like CFM has to constantly keep track of and factor into their strategy.
Absolutely. And what Bouchaud and his team found is really remarkable. This relationship between the size of a trade and its impact on the price isn't just random. There's a pattern to it. They call it a universal law.
Universal, meaning it's the same across different types of assets and in different markets all around the world.
Exactly. Bouchaud's research suggests that this fundamental law holds true whether you're trading stocks, bonds, or any other kind of financial contract. And it works in major financial hubs like London, Paris, Tokyo, Australia. It's not just some local quirk.
That's amazing. So if the basic pattern is universal, what causes the specifics to change from one asset or market to another?
That's the cool part. There are two main factors that determine the specific characteristics of this price impact law for a given asset. The first is volatility. That's how much the price tends to jump around naturally.
Makes sense.
And the second is liquidity. How easy is it to trade in normal amounts? Once you account for those two things, the basic formula that describes the price impact is remarkably similar across different markets and asset types. It's like there's this underlying engine, but the settings are adjusted based on what you're actually trading.
I remember Bouchaud mentioning that the price impact isn't linear. What does that mean, in plain English?
It means that if you double the amount you trade, the price impact won't also double. It'll be less than double.
Oh, interesting. So there's not a direct one-to-one relationship between how much you trade and how much the price moves against you. How does Bouchaud explain this nonlinear effect?
He goes back to the hide-and-seek analogy.
Yeah.
As you start buying, the price begins to creep up. That very movement attracts sellers who are sitting on the sidelines waiting for a slightly better price.
Right, I get.
And this influx of new sellers effectively reveals more of that hidden liquidity and stops the price from rocketing up too much. And it works the other way, too, when you're selling. If the price starts to dip, that pulls in more buyers. This dynamic is why the price impact isn't linear. The market kind of corrects itself as it goes along.
So the market itself responds to those little price changes by bringing in more players, which kind of cushions the blow of a large order being executed in pieces.
Exactly. And Bouchaud's work goes beyond just identifying and studying these patterns. He's actively pushing for a deeper understanding of all this through initiatives like a conference called Market Microstructure, confronting several points of view.
What's that about? Tell me more.
Well, the goal, and it's been held a few times now, is to bring together a bunch of different experts who all want to understand how prices form at this super granular level. We're talking economists, financial theorists, mathematicians, computer scientists, even physicists, academics, and people working in the trenches of finance, every day.
Wow, that's a diverse group. Why the need to bring in so many different perspectives?
Because they believe that to really understand market microstructure, you need this interdisciplinary approach.
Yeah.
It's not just an economic problem. It's not just a math problem. It's about human behavior, the tech behind the trading platforms, all these players interacting with each other.
I see.
By getting all these different viewpoints together in one room, they're trying to get a more complete picture of why prices move and how we can design markets that are more efficient and stable.
Fascinating. What kind of practical applications have come out of all this work on market microstructure?
Oh, there are quite a few. For example, it can provide really valuable insights into the potential effects of financial transaction taxes. The debate comes up every now and then.
Right.
It also helps us understand the role of those high-frequency traders. What impact do they have on things like market liquidity and volatility?
Yeah.
Because market microstructure looks at trading activity in such detail, it's becoming really important for informing policy decisions about regulations and for understanding what drives market stability at a fundamental level.
Bouchaud mentioned that this is a relatively new field, only about 15 or 20 years old. What's been the main driver for its development?
The main thing has been the explosion of high-frequency data. We're now able to collect and store and analyze massive amounts of data on individual transactions.
Right.
This means researchers aren't just stuck with theoretical models anymore. They can actually test their hypotheses about how markets work using real-world evidence in real time.
That makes a big difference.
It does. And this kind of data is now available not just to researchers, but also to investment funds and, importantly, to regulators.
So it's the combination of having this super rich data and developing sophisticated theoretical models to interpret it that's really pushing the field forward. Exactly. Bouchaud emphasizes how important this back and forth between theory and data is. Without good data, theoretical models can make incorrect assumptions about market behavior.
Right.
But just staring at the data without a theoretical framework, well, you can miss those underlying principles like the price impact law we talked about. You need both to really get it.
So if we're summing up some of the key takeaways from our deep dive into Bouchaud's work, even in markets that seem super liquid on the surface, trying to make large trades quickly can hit some unexpected roadblocks.
Yeah.
There might not be enough immediate liquidity, so you got to break those orders down.
Yep.
And each one of those smaller trades, no matter how small, it has a real impact on the price. And ultimately, that increases the cost for buyers and reduces the proceeds for sellers. That's right. And this price impact isn't random. It follows a universal law. And the specifics are determined by how volatile and liquid the asset is. And it's not linear. So trading larger volumes doesn't necessarily translate into proportionally larger price movements. And that's because of the dynamic way buyers and sellers are interacting in the market.
And finally, this field of market microstructure, while still relatively young, is crucial for understanding these complexities. It helps inform those debates about regulations, and ultimately, it contributes to more stable and efficient financial markets.
Totally. It forces us to look beyond these simplistic ideas about market liquidity and appreciate the intricate dance that happens every time a trade is made.
So, for everyone listening, whether you're actively trading and investing or just interested in how financial markets tick, think about this. How might this understanding of transaction costs and price impact change your perspective? Could this knowledge, even in a small way, change how you interpret the news about the markets and all those ups and downs we see in prices?
Yeah, food for thought.
It is indeed. It really is.